Hello, 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 everyone. Welcome back to another episode of Milkshakes, Markets, and Madness. This is a show where we talk about the financial markets. We talk about the madness surrounding those financial markets. And we do it all through the lens of the dollar milkshake theory, which is a framework for understanding how the monetary system works and how it may react in a sovereign debt crisis. And so what I thought we would talk about today is China dumping their treasury bonds and what that means for the United States. But before we get to that, the maddening thing for me today, not that you guys care about this stuff, but the maddening thing for me is I'm sitting here trying to figure out how can I do this without the light reflecting off of the light off of my glasses and making me look ridiculous in this video. But the problem is I'm blind and I can't read the slides that I'm going to look at you if I don't wear my glasses. So anyway, I've been sitting here for about 20 minutes before starting this, trying to figure out how to solve that problem. I have not solved it yet. Anyway, let's get back more into the, oh geez, and look, we have a special guest here. Look who it is. It's Gus. Gus is sitting on my lap. This is a real dog, by the way. That he wants to get off my lap now, so I've got to let him off. Anyway, sorry for all the drama, but let's get back to China selling US Treasuries and what that can mean for the US, and not just China, other people around the world. You know, they're not going to buy the US debt anymore, and it's going to lead to all kinds of madness and mayhem. Well, let me pull up a couple slides here because I think this is important to kind of set the stage. So I think a lot of times when people will hear my dollar milkshake theory and hear me say that the U.S. is going to outperform the rest of the world, they think that I somehow don't understand the precarious situation that the United States is in regarding its fiscal policies. But that's not the case at all. It's actually the U.S. fiscal policies and the situation that we're in that kind of helped me develop the thesis in the first place. And I have always said that the U.S. debt is going to grow much bigger than anybody thinks it is, and that the budget deficit will grow deeper or greater than many people think possible. It's just that it won't lead to the quote-unquote end of the United States as quickly or in the way that many people thinks that it will. And the other thing that I wanted to point out, and so I tweeted this out, you know, Zero Hedge posted this chart earlier today, and I just tweeted it out saying, listen, I mean, this is not going to stop. This is going to continue up and to the right. And if anything, it probably accelerates. And any downturn will be quickly reversed to the upside. But the other thing, the point that I wanted to make is that not only are there a lot of people who thinks that this spells dread for the United States, which in the long term it probably does, but there are a lot of people out there that use this as a trading tool or a timing tool and think that this can't possibly last. And the point I would want to make is I've been doing this for 25 years now. For almost all of that 25 years, I have been hearing that this is right around the corner, that the Fed is cornered, that they are out of policies, that there's nothing left that they can do. And yet here we are all this time later. And I think when we think about these things, you got to really be honest with yourself. I mean, how many of you thought after, 2008, that 15 years later, we would still be talking about this stuff? I'm the first to admit that I thought this would have, kind of come to an end long before that. In 2012, 13, 14, I couldn't figure out how it was still going. It took me a little bit to kind of figure out why it is still going and why I think it could go longer. But I think this is something that we all need to kind of understand, that is the big difference between inevitable and imminent, and not knowing the difference between those things can have severe impacts on your portfolio. Anyway, let's move forward a little bit. The other thing, we've talked about this before. I think a lot of times, because I talk about the US dollar, they equate that to US Treasuries. And in a way, they're the same, but in a way, they're not. And the point I want to make is that I have never been a US Treasury bull. It's not to say that Treasuries won't necessarily go higher, but that has never been my thesis. In fact, it has always been my thesis that interest rates would go higher. When interest rates go higher, bond prices fall. That includes US Treasuries. And it was bond prices falling and the end of the 40-year bond bull market coming to an end that would lead to the dollar going higher. And what I mean by that is as Treasury prices fall, interest rates rise. As interest rates rise, it makes holding at least short-term U.S. Holdings in U.S. cash more attractive because you get paid a lot more to do so. So as the federal funds rate goes higher, you get paid more to hold on to the dollars. And since much of the world already needs dollars anyway to operate in the current monetary system and operate on the global stage, it just makes the dollar that much more attractive. And so as bond prices fell, not only as bond prices fell would interest rates rise, but bond prices falling could have ramifications for markets all around the world. So not only would the higher interest rates be a catalyst to push the dollar higher, but the potential chaos caused by US Treasury rates falling and interest rates higher could see a safe haven bid into the United States dollar. So you must understand the difference between being a US dollar bull and being a US Treasury bull. And this chart that I have up here now, this is basically showing the white line is the dollar index. The blue line is the 10-year, I'm saying the blue line is the 30-year US Treasury. This is their future, so it's price. And the orange line is the 10-year US Treasury futures. But you can see it's not perfect, and it doesn't always hold this way. And I'll go over a few reasons why it's not always an inverse relationship. But the reason it is often an inverse relationship is because of the interest rates that we were talking about. And you can see by looking at this, the white line in general trades counter to the blue and the orange line. So as bond prices were falling in 21, 22, the dollar rose dramatically. You can also see this a little bit back in what was that, 2017. As bond prices rose, then the dollar fell. As interest rates were coming down and bond prices were going higher, then the dollar fell. And so again, it's not a perfect inverse relationship, but it is an inverse relationship. And that is one of the reasons why I thought as interest rates went higher, the dollar would go higher as well. Now, again, I said this isn't always the case. And in fact, there's a thesis. This is not mine, by the way. I'm not exactly sure who came up with it, but there's the dollar smile theory. And that is that when things are really good and the U.S. is growing and the economy is strong, then there's demand for the dollar because people want to invest in the United States. And so to invest in the United States, you need dollars. That's kind of the right side or the right tail. The opposite is in some kind of an adverse negative scenario because the whole world runs on dollars and because the whole world has dollar-based credit exposure. As the dollar falls, it becomes in higher demand, especially in a slowdown, and so the dollar can rise in some kind of an underperforming or a crisis scenario. But the area in the middle, it doesn't really matter. The dollar can go back and forth, it can go up and go down, but again, it's on. So in some kind of an adverse scenario where things are really bad, you could obviously see U.S. Treasuries and the dollar rally together. So this goes back to the previous chart. It's not always an inverse relationship, but it often is. Anyway, let's go back to the U.S. fiscal position, and this also goes back to the Fed being cornered. Again, a lot of people will say, who is going to buy the U.S. debt? You know, they've borrowed 35, 36 trillion. The budget deficit just continues to grow. There's no end in sight. You know, the fiscal dominance is taking over. The Fed is out of bullets. Who is going to buy the U.S. debt? Well, again, I've been hearing this forever. For as long as I can remember, I've been hearing this question, and yet it still gets bought. And it gets bought for several reasons. Number one is the primary dealers who stand up at Treasury auctions have to buy them. It's their job. I don't know if it's actually a law, but I think it's actually a law that the primary dealers must take down the entire issuance of U.S. Treasuries. And if they don't take them down, then guess what's going to happen? They're not going to be a primary dealer anymore. So think about this. Jamie Dimon's a pretty smart guy. If you think that you know more about finance than Jamie Dimon does, well, I wish you luck. But a lot of people will say, why would anybody buy a Treasury bond? There are horrible stores of value. The interest rates are going to go higher. They're obviously going to lose against inflation. So what does Jamie Dimon know that you don't know? Why is JP Morgan step up at these primary dealers? You think that Jamie Dimon doesn't understand inflation? You think he doesn't understand that low yielding bonds in a highly inflationary market lose value? Well, part of the reason he buys them is he probably has an idea of how to use them that you don't. But the other reason is because they've got a primary dealer license. And if they don't have a primary dealer license, or if they don't step up and buy these, then they're going to lose their primary dealer license. Now, do you think, my point here is, do you think Jamie Dimon likes being a banker? I mean, he's been doing it for basically his whole life, so his whole adult life. And has enough money that he can do whatever he wants to do. So if he's been doing his whole life and he has enough money that he can do whatever he wants to do, and yet he's still a banker, do you think he likes being a banker? My guess is he likes being a banker, right? So how do you think he would feel if the US government came along and yanked his license? So, I don't think he would be too happy about that. I think he would probably be kind of sad. And so that's another reason why he steps up and buys these, right? Because if he doesn't, the US government will put somebody in his place that will, or they will put another bank in his place that will do it. And I know that there's people out here saying, well, that's manipulation. That's not a free market at work. That's going to actually end up hurting the United States as well. And yes, you are absolutely right. But it's also the way the real world works. And so, and the other thing is, just because it will end up being bad in the long run doesn't mean it's going to be bad tomorrow or the next day or next year. And so, again, I think you have to be very careful about understanding where things are going to end up in the long run, affecting how you allocate your portfolio today. It's not that you shouldn't take the long term into account. It's not that you shouldn't be prepared for that. But you shouldn't necessarily set up your portfolio to respond tomorrow to something that's going to happen 5, 10, 15, 20, or 50 years from now. We don't know when it exactly will happen. But the other thing, the reason I like this tweet that I sent out is this goes back to the Fed not even having any more tools. I'm here to tell you that I'm not a fan of central bankers. I don't think they're necessary. And if I woke up tomorrow and they weren't around anymore, I wouldn't be very upset about it. But the real issue is that they exist in the real world, and I have to deal with them. And the idea that they don't have any more tools, or that they are in a box or in a corner that they cannot get out of, I would encourage you to rethink that. These are incredibly smart people. Now, they may be completely misguided. They may be off base. They may sometimes be out to lunch. They may not get everything right. You may even think that they're evil, and I wouldn't necessarily argue with you if you thought that. But these are not stupid people. And they have tools that they haven't even begun to use yet. And one of them is forcing all of us to buy the treasuries. Now, that's a very simple one, but they could very easily go to all the banks and the institutions and the hedge funds and the endowments and say, listen, due to reasons for national safety and your own safety, or whatever strategic reason they come up with, it is now mandated that 10% of your portfolio has to hold 10-year or 20-year US Treasuries. Now, would there be pushback? Would there be outrage? Would there be people upset? Of course there would. Of course there would. But it could still happen anyway. I mean, think about all the things that happen right now that already outrage you, right? Just because something isn't right, just because you don't like it, just because there's going to be outrage, doesn't mean it won't happen. Now, again, it doesn't mean it's going to happen tomorrow. I'm just saying there are things that before this whole thing comes, to crashing down, many, many more things are going to be tried and put in place. This isn't just going to happen where the whole, U.S. government finances crash tomorrow without them trying to plug a few more holes, without them pulling a few more rabbits out of the hat. So anyway, that's enough of that soapbox. I just wanted to point that out. The other thing I would say is, just because interest rates are going higher does not mean the U.S. will collapse. Doesn't mean they won't. It's possible. But again, just because interest rates go higher doesn't necessarily mean we're going to have a cascading, default of US Treasuries. Nobody's going to buy them. The dollar is going to go into hyperinflation. And, we're just going to end up this big smoldering mass of North America. So, and for proof of this, just look back to 2020. right? After COVID, they took interest rates lower, they printed money. How many people, how many of you listening now said they will never stop printing money and they will never raise interest rates again, right? And then when they actually did start talking about raising interest rates, how many people thought, well, they'll never actually do it? And then when they raised once, how many people said, well, now that they've raised once, credit is going to be constrained. We're going to have a huge recession. The market's going to collapse and we're going to have a 2008 all over again. And then they raised over, I don't know how many actual raises. Was there 7 or 8 raises? Anyway, it went from 0 to 5.5%. Now, there's not too many people that thought the U.S. could take interest rates from 0 to 5.5% without causing a recession, let alone, or something worse, like a global catastrophe. But yet they did, right? And so again, you put that in the back of your mind and say, for all these things that you don't think can happen, is that something that you didn't think could happen? And if that was able to happen, what else could happen that you don't think that's able to happen? So my point with this is that interest rates going higher in general makes it tougher for the global system to operate. But it will make it tougher for the rest of the world than it will make it for the rest of the world than it will make it for the United States. Because again, at the end of the day, the U.S. has many tools that it can still use. And the most effective one or the most powerful one is the printer. If you're playing poker and you have a machine under your chair that lets you print more chips, how does anybody knock you out, right? And sure, does that mean that the chips lose purchasing power? Yeah, probably. But again, the whole world has U.S. debt. The whole world has taken on the extension of U.S. credit. As interest rates go higher, it affects the rest of the world just as much, if not more, than it affects the United States. And if you need any proof of this, just go back to 2022. In 2022, as interest rates went higher and the dollar went higher, it started the precipitation of the Chinese market melting down. And over the last 2 or 3 years, we've seen that really, really fall. In 2022, we saw the Bank of England have to bail out their government bond market. We saw the ECB have to set up a special facility to buy periphery bonds, specifically Italy. And we saw Japan have to bail out both the yen and the JGB market. So, while stock prices went down in the US, we're still here, and we're still operating. So just because we took interest rates higher, it didn't cause a collapse. Now, I know people are saying, well, yeah, but now they're cutting. Okay, so they've taken it from 5.5 back to 5, but it's still 5% higher than it was a couple of years ago when people didn't even think they can raise rates. And people say, well, yeah, but it is still going to happen. And I will say, okay, you're right. It is still going to happen. But 2 or 3 years ago, you thought it was going to happen imminently, and it hasn't. So again, don't use these long-term inevitabilities as short-term trading tools. And so, I think this is probably a good part to get into this next part, is that earlier this week, I did an interview with Eric Townsend at Macro Voices. And if you guys don't already know Macro Voices, this is one of the best financial podcasts out there, I think. He always has great guests, really smart people. And I always enjoy listening to the interviews that I'm not part of. So, and I talked about some stuff on this interview that I'm basically going to talk about for the rest of the time now. And the reason I decided, so if you already listened to this, it's going to be somewhat repetitive, but I wasn't sure how many people here also listen to Macro Voices, and I think it's important enough that I wanted to go over it. So I would encourage I would encourage everybody to go check out Macro Voices, and you'll hear a lot of good, smart people there. But anyway, what I was talking about with Eric was basically related to what we've been talking about so far with Treasuries. And that is, I think a lot of people know that the foreign holdings of US Treasuries, central banks have not been buying as many of them now as they used to. And a lot of times, 2014, 2015 timeframe will be referenced as that's when the official holdings, and when we say official, that's basically central banks. Central banks stopped buying US Treasuries about 10 years ago. And it's been falling ever since. But what they have been buying is gold, right? Because US Treasuries are no longer a good store of value, and fiat currency is going up in flames, and the dollar is doomed. And so they're not buying Treasuries, and instead they are buying gold, right? And so again, about a 10-year time frame is often referenced. But I think it's important to understand that even though central banks may not be buying US Treasuries to the extent that they were 10 years ago, many people around the world, many institutions, many entities are still buying US Treasuries, despite all the arguments that they shouldn't, despite the reasons that we've talked about why they will lose versus inflation or lose versus gold. They are still in demand. And in fact, foreign holdings of US Treasuries are at an all-time high. Now, this is not a slide you will often see in a newsletter because it doesn't tell a good story, but this is reality. This is the truth. Foreigners are still buying US Treasuries. Now, if we go to this slide, this shows the top holders of US Treasuries, the top 10 holders. And the red line is China. And you can see that, since, again, 2014, their holdings have been falling. And that is often pointed out that why, as evidence that, foreigners no longer want to hold treasuries. But you will also see on this slide that a number of offshore banking centers, such as Luxembourg, Ireland, Cayman Islands, they are amongst the top 10 holders. And people say, well, why are these small countries, how can these small countries be buying all these treasuries? Well, the reason is because international investors around the world still want to invest in the United States. But it's easier for them to do it through an offshore entity and then go through that offshore entity and invest in the United States. And it makes it easier for them for tax reasons. And so those locations, Ireland, Cayman Islands, Luxembourg, they are banking centers where a lot of these offshore vehicles are domiciled. And so people will invest in those funds or in those vehicles, and then those vehicles, because they have offshore tax status, can invest in the United States without being exposed to U.S. tax. And what do they buy? They buy U.S. Treasuries. Now, you might be thinking, now, why are they buying Treasuries? That's a stupid idea. Well, not everybody thinks buying U.S. Treasuries is a stupid idea. And if you are a foreigner and you can get paid 3, 4, 5% to hold a U.S. Treasury, and your currency falls versus the dollar by 3, 4, 5%, all of a sudden you have an 8, 9, 10% return for holding a U.S. Treasury. Now, again, as a U.S. investor, maybe you think this is a bad idea, but this chart shows that there is demand for U.S. Treasuries. And this was one of the points that I was making in 2018, 19, when I first started talking about the milkshake was, and people would tell me, no, Treasuries, the U.S. is going to go bankrupt because nobody will buy the Treasuries. And my point was people will still buy the Treasuries. Entities, institutions around the world will still buy Treasuries because on a relative basis, they are still attractive versus their local choices. Now, this doesn't mean that U.S. Treasury prices won't fall. It just means that we're not going to have a total strike where nobody will buy them. Now, remember, I actually think U.S. Treasury prices likely do fall and interest rates probably do rise. But that doesn't mean there's a total strike on Treasuries, and it doesn't mean that just because interest rates are rising that the U.S. government is going to collapse. Now, if we go forward, the other thing I'll point out is this shows U.S. Treasuries, foreign holders of sovereign bonds. And again, I'm referencing 2014 at the peak, and you can see that yellow line is down and to the right. Okay. The reason I'm showing this is because everybody talks about how nobody's buying U.S. Treasuries anymore. But nobody ever says the same thing is happening for Switzerland, which has also been happening for the last 4 or 5 years. Nobody ever mentions that it's happening to Austria and Belgium and Finland and France and the Netherlands. Nobody ever mentions that it's happening to Greece and Ireland and Portugal and Slovenia and Spain. And nobody ever mentions that it's happening to Australia and the Czech Republic and Denmark and Sweden. The point is that it's not a uniquely American thing that foreign official holders are no longer buying U.S. Treasuries. This is a global phenomenon, and a lot of it has to do with interest rates rising, right? And people looking for alternative sources of yield. So even if it is true that the rest of the people around the world don't want to buy treasuries as much as they used to, even though our holdings are, foreign holdings are at an all-time high, it's a relative game, right? And in a relative game, the same thing is happening to almost all countries around the world. Now, there's a few exceptions here and there, but in general, holding foreign sovereign bonds is on the decline. And so, it's not something that is unique just to the United States and means the United States is going to fail. In other words, if that chart that often gets held up means the US is going to fail, what does it mean about all these other countries that the chart looks the same? But let's go to China now, because this is a very famous chart. And this shows that China's holdings of US Treasuries peaked back in 2014. They stopped buying them and they've been steadily selling them. And then they started selling them much faster in 2021, 2022 timeframe. And you can see that it's just down and to the right. And I think, they will say that China has sold $400 billion worth of US Treasuries because they used to own 1.1 billion and now it's down to like 700 million or 700 billion. And so they've sold $400 billion or whatever the number is, worth of US Treasuries. So I think it's important for people to understand that this chart does not say what many people thinks it says. This chart comes from the Treasury International Treasury International Capital. I can't remember the exact name of it, but it's the data that goes into this chart comes from the United States Treasury. So the US Treasury publishes this, and then it gets put in these charts that get sent around. This chart that I'm using here is from Bloomberg, but whenever you see these charts, the source of it is the TIC data, TIC data, which is Treasury International Capital, Anyway, if you actually go to the footnotes on these reports, it shows that what these charts are showing is not just sales. It is showing purchases, sales, and fair value change. In other words, these charts, this chart right here, is showing the current market value of the bonds. It's not showing the number of bonds held. It's showing the current US dollar value of the bonds. Okay? So again, this is straight from their website, the Treasury's website. Purchases, sales, and fair value changes. Now, I know that there are some people saying, well, that's not really what that means. Well, I can tell you, I have spoken directly to the US Treasury more than once to confirm that that TIC data that they produce references current market value. Now, it does also include purchases and sales. So it's not that there's no sales going on in that chart. There really are, I'm sure, some sales taking place here. It's just that this is not a chart showing sales only. It's showing sales, it's showing purchases, and it's showing change in current market value. Now, the other thing is that I've had people tell me, well, in the last year, the TIC data has been changed and this new report shows fair value changes, but it wasn't like that beforehand. That is also wrong. I have spoken to the US Treasury. I have emails from the US Treasury confirming that it is fair value changes and that it has always been fair value changes. So the people that produce these reports, not somebody who is trying to make a point somewhere, not somebody who's trying to sell something, are telling me, and I am telling you, that these are current market value reports. Now, what does that mean for this chart? What that means is that if I go back here, right? I go back here and I look, if we look at the second circle on the right, and then the arrow going down to the right, what I've done here is I've zoomed in. So from 2021 going forward, the white line is that TIC data, and it shows US Treasuries holdings by China falling by several hundred billion. The green line, the light green line, and the aqua line are again US Treasury prices. the 10-year US Treasury price and the 30-year US Treasury price. And you can see, plain as day, that the fall in China holdings almost perfectly reflects the change in price. It reflects the change in value of the Treasury bonds that China owns. Now, it doesn't mean that there was no sales by China. I'm sure there were some sales by China. But what it means is that China did not sell $400 billion worth of US Treasuries. They're not dumping at fire sale prices Treasuries. And you can even see on a month-to-month basis, you can see, I think back in 2021, where there was actually an increase in Chinese Treasuries, and then it fell down, and then it went sideways for a while, and then it fell, and then it rose again in 2022. So unless you think China is day trading US Treasuries, the fact that you will see short-term rises in China's holdings at the exact same time that US Treasury prices are rising, then this is obviously reflecting the price changes, or largely reflecting the price changes. So again, when you hear somebody say, "Oh, China's dumping Treasuries, and this is going to be a stake in the heart for the United States," or when you hear him say, there's similar charts showing Saudi Arabia and other countries. But when you hear people say these things and they show you these charts, you have to understand what the charts are actually saying. Regardless of what they tell you the charts are saying, the people that produce those reports are telling me what they're saying, and it's right there in their footnotes. And you just, again, you can believe what you want to believe, but this largely explains the fall in Chinese treasuries over the last 2 or 3, 4 or 5 years. And it largely explains why you see the fall in US treasuries of other countries around the world. So just understand what the reports are showing and what they're not showing. I think that's very important. Now, the last couple of things I want to cover before we leave is, we've obviously talked about gold and silver a lot over the last couple of years, over the last couple of weeks. And I wanted to update on the position of the commitment of traders. Again, we've talked many times that, and we just referenced it earlier in this one, that, governments around the world, institutions around the world aren't necessarily buying treasuries at the rate that they used to be, but they are buying gold. And that's always been a part of the milkshake, was that gold and dollar would rise together. And we're seeing that in spades, over the last year, especially. But as that has happened, we've also seen this commercial short position in gold rise, and it's not quite to all-time highs, but it's getting very close. And so I know people have liked it when I've posted this. I wanted to show you where we're at. Gold hit another all-time high this week, closed at an all-time high, and the short position rose a little bit. And again, we got to remember these reports are delayed like 4 days, so it doesn't include the last 3 or 4 days. But the more interesting one to me is silver. So this is silver. And last week is when silver made its very big move higher. Or was it last week or 2 weeks ago? I can't remember. But when that was happening, there was a lot of people speculating that the reason that silver jumped as much as it did was that it was short covering by the commercial banks who had a large short position, and that they were stuck, and the banks were going to go bankrupt because they were stuck in this large short position, and that they were probably covering, and as a result, that's why the price was going higher. But when we now, having looked over the last couple of weeks, the commercial short position has not gotten dramatically smaller. The commercials were not covering their shorts, and the actual short position actually got bigger rather than getting smaller. So we'll still see, what takes place from here. But that's kind of the update there. And I think that's it for this week. I just wanted to go over that stuff again. If you didn't get it, if you already listened to it on Macro Voices, I know this was a little bit repetitive, but I hope this was informational for you guys. And I'd recommend that you check out Macro Voices, not just for my interview, but for all their others. And that's it. Hope you guys are good, and we'll see you again next week. Bye.